Some of the best tax planning is both inevitable and free. Hi, I'm financial planner Sean Mullaney. Let's discuss. So, this planning isn't the feel good planning of the year, but it is important. It's called the step up in basis. It happens when someone dies. Their assets, at least those assets in taxable accounts, are inherited by their heirs. It could be a spouse, it could be children, it could be friends, it could be parents. Whoever inherits those accounts, generally speaking, get a so called step up in basis in those assets. What that means is when they go to sell the inherited asset, they have a basis in that asset that is equal to the fair market value of that asset on the day you died. So this is a really good tax planning opportunity. It means that your heirs can inherit many of your assets, and if they have no interest in keeping those assets, whether it's a house, financial assets, whatever it may be, as long as it's not in a retirement account, guess what? They sell that asset and they have no gain or loss, or very little, because there might be some gain or loss between the time you died and the time they sell. But this step up in basis is a really valuable tax planning opportunity for those who inherit assets. However, you have to keep a few things in mind. One of them is that the step up in basis does not obtain for retirement accounts, and it doesn't obtain for HSAs. Now, spouses usually step into the shoes, roughly speaking. There's all sorts of permutations. That's not that big of a deal when you're leaving it to a spouse. But if you're leaving a retirement account, particularly a traditional retirement account or an HSA, to a non-spouse heir, that can create some problems from a tax perspective. Not the worst problem in the world, right? They're still inheriting an asset, but it can be less than optimal from a tax perspective. Okay, so now we know that step up in basis, it obtains when we die to our taxable assets, our heirs get a step up, the fair market value on the date of our death. That's good news. Here are three implications that follow from that step up in basis rule. The first one is those looking to give assets to heirs ought to be real careful about gifting during their lifetime. So here's an example. Let's say you bought company X stock years ago for $1,000. And guess what? Now it's worth $10,000. Okay, great. And now you're thinking, hey, I've got a son. I want to give $10,000 to my son. So maybe I'll just go ahead and give that company X stock that's now worth $10,000 to my son. Okay, if you do that, not the best tax result, because your son inherits your basis when you bought it if you gift it. But if you leave it to your son at death, your son gets a step up in basis. So that could be a real big difference to your son. Is your son's basis going to be $1,000? That's if you gift it to him during your life. Or is your son's basis going to be $10,000 because you left it to them at your death, and maybe the fair market value is something like $10,000 on the day you died, right? So that's one implication. It also means that what you probably want to think about when you're gifting is maybe cash from a tax perspective might be the most efficient asset to gift. The reason is it doesn't matter whether you leave cash at death or you gift it during your own life. Your heir, your son, your daughter, whoever it might be, they just get the basis of cash is cash, right? It's US dollars. If you give them $10,000, they now have $10,000. There's no gain or loss in that. And that's true whether you gift it during your life or whether you leave it at death. So cash often can be a nice asset to gift if we're thinking about tax optimization. The second thing to be thinking about with this step up in basis, the second implication is this classic debate, particularly for the early retiree. Do I do a Roth conversion or do I do tax gain harvesting? I'll link some blogs below in terms of Roth conversions, tax gain harvesting, and the like. But here's the deal. When we get early retired, oftentimes we have artificially low taxable income, and that opens a tax planning opportunity. So you might think, well, I have two things I could do. One might be to convert old traditional retirement accounts to Roth accounts. affirmatively create taxable income, but understand that I'm in a low tax bracket. Maybe I'm only in the 10% marginal or 12% marginal tax bracket. So great, I just pull the trigger on some Roth conversions, get money out of a traditional IRA into a Roth IRA, for example, right? That could be one lever to pull from an early retirement tax planning perspective. Another, though, could be this tax gain harvesting. If I'm in the 12% or lower federal marginal tax bracket, I can go ahead and trip some gains, actually sell appreciated stock or securities, mutual funds, whatever it might be, and then rebuy them shortly thereafter and sort of reset the basis. And because I'm in that 12% tax bracket, I get a 0% long-term federal income tax rate on that gain. All right, step up in basis. How does that factor into that decision? Well, here's the thing. The tax gain harvesting solves for the problem of, oh, I have a built-in gain in a taxable account. I don't want to pay tax on that, so I tax gain harvest when my income's low. That's great, but here's the thing. Tax gain harvesting is not the only way to solve that problem. Another way to solve that problem is by the step up in basis at death. So if everything else is equal in my planning, maybe what I do is I say, you know what, I'm going to prefer Roth conversions to tax gain harvesting, because at death, there's no step up in basis in the assets in my traditional IRA. Those assets are going to suffer ordinary income, whether I pay it or my heirs pay it. Somebody in human history is going to pay the tax on those tax deferred traditional IRA, traditional 401k assets. So maybe because of the step up in basis, what I do is I do Roth conversions when I'm in the 10%, 12% bracket. And then what I do to solve the problem of the tax of the built-in gain on that stock that's in my taxable brokerage account is I rely on the step up in basis at death, right? So now we're getting sort of the best of both worlds. So that's the second implication of this issue of the step up in basis and how it affects some of our income tax planning. The third thing is rental real estate. Here's one of the cool things about the step up in basis. It's an opportunity for your heirs to redepreciate rented property, right? You bought a condo that you rent out 20 years ago. You take depreciation deductions against your, against the income made by that rental real estate for 20 years, and then you die. Too bad. Now your heirs get the condo and they can rent it out and get the income. But guess what? Their basis for depreciation purposes resets. So they can get a whole lot more depreciation if and only if they're able to use that step up in basis. So what that means is maybe we don't want to hold rental real estate in something like a traditional IRA or a 401k or something like that. Because here's the thing, there's no step up in basis inside an IRA or 401k. So our heirs are still going to pay tax if they're taking money out of a 401k or a traditional IRA that's holding rental real estate. That's not going to be that great of an outcome. It's going to be all ordinary income to them. So those are three implications of some of the best tax planning available, which is both free and inevitable. The step up in basis in taxable accounts at death. Let me know if you have any comments. Put them in the comments below. If you like this video, please mash that like button and subscribe to my channel. I'll see you next time.